Hey everyone, and welcome back to the channel. Today, we're diving deep into a topic that might sound a little complex at first, but trust me, it's a powerful tool for building wealth that you'll want to understand. We're talking about how to make money with municipal bond, closed-end funds, or CEFs for short. If you're looking for ways to generate regular income, potentially with some nice tax advantages, and benefit from unique market opportunities, you've come to the right place. So grab a notebook and let's get into it. First things first, what exactly are we talking about? Municipal bonds, or munis, are essentially loans you give to state and local governments to fund public projects like schools, bridges, and highways. In return, they pay you interest. A closed-end fund is a type of investment company that pools money from many investors to buy a portfolio of these bonds. Unlike mutual funds, CEFs issue a fixed number of shares that are then traded on a stock exchange, just like a regular stock. This unique structure is what creates the special opportunities we're going to discuss today. So let us break down the first and most popular way to make money with these funds: generating regular income. The primary goal of a municipal bond CEF is to provide a steady stream of income to its shareholders. The fund collects interest payments from all the different bonds it holds and then distributes this income to you, typically on a monthly or quarterly basis. It's like setting up a financial pipeline that sends cash directly to your account. Now, here is the real kicker and a huge reason why investors love muni bonds. This income is often tax exempt. Specifically, the income from municipal bonds is usually exempt from federal income tax. And if you invest in a fund that holds bonds issued by your own state, the income might also be exempt from state and local taxes. This is a massive advantage. Think about it. A 5% return that is tax-free can be equivalent to a 7% or 8% taxable return, depending on your tax bracket. This tax-free nature means more of the money you earn actually stays in your pocket, significantly boosting your effective return. For anyone in a higher tax bracket, this is a financial strategy you simply can't afford to ignore. The second way to profit is a bit more strategic and really highlights the closed-end nature of these funds. It's all about capturing price discounts. This is where things get really interesting. Remember how I said CEFs trade on an exchange like stocks? This means their market price is determined by supply and demand, by what buyers are willing to pay and sellers are willing to accept. This market price can, and often does, differ from the fund's net asset value, or NAV. The NAV is the actual per share value of all the bonds inside the fund's portfolio. When the market price of the CEF is lower than its NAV, it's said to be trading at a discount. This is a fantastic opportunity for savvy investors. Essentially, you're buying $1 worth of high-quality municipal bonds for, say, 90 or 95 cents. It's like finding a high-end product on sale. Your goal is to profit when this discount narrows, or even better, when the fund's price swings to a premium, meaning it trades for more than its NAV. There are two main ways to play this. You can use a buy and hold strategy where you purchase a fund at a deep discount, collect the attractive income stream, and simply wait. Over the long term, these discounts tend to revert to their historical average, so you benefit from the income and the potential price appreciation as the discount closes. The other approach is a more active trading strategy. You'd actively look for funds trading at unusually large discounts. Buy in and then sell your shares once the price recovers and the discount shrinks or becomes a premium. This requires a bit more monitoring of the market, but the potential for short-term gains can be significant. It's a classic case of buying low and selling high applied to a fund structure. The third method for boosting your returns is through leverage. This is a powerful but also riskier component of many CEFs. Leverage simply means the fund borrows money at a low short-term interest rate and uses that borrowed cash to buy more municipal bonds that pay a higher long-term interest rate. Let us say the fund can borrow money at 2% and buys more bonds that yield 4%. That 2% difference, or spread, is extra profit. This additional income gets passed on to you, the shareholder, effectively juicing up your dividend payments and the fund's overall return. When this strategy works well, it's brilliant. It can turn a good yield into a great one. However, it's crucial to understand that leverage is a double-edged sword. It magnifies returns on the way up, but it also magnifies losses on the way down. If interest rates rise suddenly, the fund's borrowing costs could increase, squeezing that profit spread. Also, rising rates would cause the value of the bonds in the portfolio to fall, and leverage would amplify that decline in the fund's NAV. So while leverage can be a major benefit, It also adds a layer of risk that you need to be comfortable with. Always check a fund as a leverage ratio before investing to understand the level of risk you're taking on. Next up, we have capital appreciation. This is the fourth way to make money and is tied to the fundamental value of the bonds themselves. Capital appreciation happens when the share price of your CEF goes up. This can happen for a couple of reasons. As we already discussed, it can happen when a discount narrows, but it can also happen when the fund's underlying NAV increases. The NAV of a bond fund generally rises when interest rates fall. Why? It's a simple relationship. Imagine your fund holds a bunch of bonds paying 4% interest. If new bonds are being issued at only 3%, those older 4% bonds become more valuable and their price goes up. This increases the fund's NAV, which can then pull the market price of the CEF shares up with it, leading to capital gains for you if you decide to sell. So, if you believe interest rates are likely to head lower in the future, investing in a municipal bond CEF could be a smart move to position yourself for potential capital appreciation on top of the regular income. Finally, let's tie this all together with the fifth strategy, a long-term compounding approach. This is less of a distinct method and more of a powerful mindset for using these funds. For many investors, the best approach isn't to actively trade in and out, but to adopt a classic buy and hold strategy. You find a quality municipal bond CEF, perhaps one trading at a reasonable discount, and you hold on to it for the long term. But here's the key to turbocharging your results. Reinvesting your dividends. Instead of taking the monthly income as cash, you use it to automatically buy more shares of the fund. When you do this, you're harnessing the incredible power of compounding. Your new shares start generating their own dividends, which then buy even more shares, and so on. Over years and decades, this creates a snowball effect that can dramatically accelerate the growth of your investment. You're benefiting from the income, the potential closure of the discount, and any capital appreciation, all while your growing number of shares generates an ever-increasing stream of income. It's a patient but incredibly effective path to building substantial wealth over time. So, to recap, you have 5 primary ways to make money with municipal bond closed-end funds. First, generating a steady stream of tax-advantaged income. Second, buying funds at a discount to their NAV and profiting as that discount narrows. Third, benefiting from the enhanced returns provided by leverage, while being mindful of the risks. Fourth, achieving capital appreciation as the value of the underlying bonds increases, often when interest rates fall. And fifth, using a long-term strategy of holding and reinvesting dividends to let the magic of compounding work for you. Municipal bond CEFs are a unique and powerful corner of the investment world. They offer a combination of income, tax benefits, and strategic opportunities that you just don't find in many other asset classes. Of course, like any investment, they come with risks, including interest rate risk, credit risk, and the risks associated with leverage. It's essential to do your own research. Understand a fund's portfolio and strategy, and make sure it aligns with your own financial goals and risk tolerance. But for the informed investor, they can be an absolutely fantastic tool for building a robust and efficient investment portfolio. I hope this detailed breakdown has demystified municipal bond CEFs for you and shown you the potential they hold. If you found this video helpful, please give it a thumbs up. And don't forget to subscribe to the channel for more deep dives into smart investing strategies. If you have any questions, drop them in the comments below. I love hearing from you and will do my best to answer. Thanks for watching, and I'll see you in the next video. Hey everyone, welcome back to the channel. Today, we're diving into a topic that many of you have asked about, annuities. You might have heard the term thrown around as a way to make money, but what are they really, and how do they work? Let us clear up the confusion and see if an annuity is the right move for your financial future. First things first, let's get one major point straight. Annuities aren't a get-rich-quick scheme. They aren't for flipping a quick profit. Their main purpose is to create a guaranteed stream of income for you in retirement. Think of it as a personal pension plan you set up for yourself. The goal is to make sure you don't outlive your savings, which is a very real concern for a lot of people. It's about security, not speculation. So, how do you know if an annuity is a good fit for you? It all starts with a personal financial health check. You need to take a hard look at your current situation. What kind of lifestyle do you want in retirement? Are you a risk taker, or do you prefer something safe and steady? What other sources of income will you have? Maybe you'll have Social Security, a company pension, or other investments. An annuity is designed to fill the gap between the income you will have and the income you will need. If you see a shortfall, that's where an annuity can be a powerful tool. Now, this is one area where trying to go it alone can be risky. The world of annuities is complex, and the details really matter. I strongly recommend working with a qualified financial professional or a licensed insurance agent. They can sit down with you, analyze your specific needs, and help you navigate the different products out there. The LL, make sure you understand the fine print and choose a product that truly aligns with your long-term goals. Don't be afraid to ask questions, lots of them. A good advisor will be happy to explain everything until you're completely comfortable. Once you've decided an annuity might be right for you, the next step is choosing the right type. And trust me, there are several, each with its own level of risk and potential return. Let's break down the main categories. First up, we have fixed annuities. These are the most straightforward and conservative option. You give the insurance company a sum of money and they guarantee you a fixed interest rate for a certain period. When it's time to receive payments, you get a set amount, like clockwork. The beauty of a fixed annuity is its predictability. You know exactly how much you're going to get, and your principal is protected from market downturns. It's stable, secure, and simple. If you're someone who loses sleep over market volatility, this could be a great choice. Next, on the opposite end of the spectrum, are variable annuities. These are for folks with a higher risk tolerance who are looking for greater growth potential. With a variable annuity, your premium is invested in a portfolio of sub-accounts, which are similar to mutual funds. You get to choose how your money is allocated across stocks, bonds, and other assets. Your future payouts depend entirely on how well those investments perform. If the market does well, you could see much higher returns than with a fixed annuity. But then, this is a big but, there's also the risk of losing money, including your principal, if your investments perform poorly. It offers more upside, but it comes with market risk. Then there's a hybrid option that tries to offer the best of both worlds, indexed annuities, also known as fixed index annuities. These are a bit more complex. Your returns are linked to the performance of a specific stock market index, like the S&P 500. Here, that's the cool part. You get to participate in some of the market gains, but you're also protected from losses. Most indexed annuities have a floor, which is typically 0%. This means that even if the market crashes, you won't lose your principal. The trade-off is that your potential gains are usually capped. For example, if the index goes up 15%, your contract might have a cap that limits your earnings to, say, 7%. It's a middle ground approach, offering more growth potential than a fixed annuity, but with less risk than a variable one. Beyond these types, you also need to decide on the timing of your payouts. This leads us to the choice between an immediate annuity and a deferred annuity. An immediate annuity is just what it sounds like. You make a single lump sum payment to the insurance company, and your income payments start right away, usually within a year. This is a great option for someone who is already at or very near retirement and needs to turn a nest egg into an immediate income stream. A deferred annuity, on the other hand, is for future income. You fund the annuity, and then you let the money grow tax deferred for a period of time. This is called the accumulation phase. You don't pay any taxes on the earnings until you start taking withdrawals years later. This allows your investment to compound more effectively over time. This is the choice for people who are still in their working years and are planning for a retirement that is still 10, 20, or even 30 years down the road. So you've assessed your goals and chosen the type of annuity. The next big question is, where does the money come from? This is the funding part. You have a few options. You can use a lump sum of cash, maybe from savings, an inheritance, or the sale of a property, or you can make a series of premium payments over time, much like funding a 401k. A very common strategy is to use existing retirement funds. You can do a rollover from a 401k from a former employer or transfer funds from an IRA. This can be a seamless way to move money you've already saved for retirement into an annuity without triggering a taxable event. You can also use money from a non-retirement brokerage account, though there might be tax implications to consider when selling those investments. After you've funded it, the final piece of the puzzle is deciding on your payout options. This process is called annuitization at S. When you flip the switch and turn your accumulated funds into that income stream we've been talking about, and once again, you have choices. One common option is a period certain payout. This means you receive payments for a fixed number of years. Say deaths or Vinci, if you pass away before the period is over. Your beneficiary will continue to receive the remaining payments. Another popular choice is a life-only payout. This guarantees you an income for the rest of your life, no matter how long you live. This provides the ultimate protection against outliving your money. The downside is that payments typically stop when you pass away, and there's nothing left for your heirs. To solve for that, you can choose a life with period certain option, which combines both. It pays you for life, but also guarantees payments for a minimum number of years to your beneficiary if you die early. You can also opt for a joint and survivor payout. This is very popular with married couples. It provides income for as long as either you or your spouse is alive. The payment amount might be slightly lower than a single life option, but it ensures that the surviving spouse will continue to receive income, which can be a huge relief. As you can see, there's a lot to consider. Annuities can be a fantastic tool for building a secure retirement, but they are not a one-size-fits-all solution. It's about understanding your personal goals, doing a thorough financial checkup, and choosing the right product features that match your needs. The key is to see annuities as a tool for income security, not for high-risk short-term profit. When used correctly, they can provide peace of mind and financial stability for years to come. Thanks so much for watching today. I hope this cleared up some of the mysteries surrounding annuities. If you found this helpful, please give this video a thumbs up and consider subscribing for more financial content. Drop your questions in the comments below and I'll do my best to answer them. See you in the next video. Hey everyone, and welcome back to the channel. Today, we're diving deep into a topic that's been shaking up the world of finance, peer-to-peer lending, or P2P lending for short. You've probably heard of it, but what exactly is it? And could it be a smart way for you to earn some extra income? By the end of this video, you'll have a complete guide to how it works, the potential returns, the risks you absolutely need to know about, and some solid strategies to get started. Let's jump right in. So, what is peer-to-peer lending at its core? Think of it like being a mini bank. Instead of putting your money in a savings account where a big bank lends it out and gives you a tiny fraction of the interest, P2P lending cuts out the middleman. Online platforms connect people who want to invest money directly with people who need to borrow it. You, the investor, get to lend your money out, and in return, you earn interest. The platform handles all the heavy lifting: the administration, the credit checks on borrowers, transferring the funds, and processing the monthly payments. It's a more direct way of putting your money to work. Let's break down how this process works for you as an investor. First, you sign up on a P2P lending platform. Before any borrower gets listed, the platform does its homework. They vet the borrowers by looking at their creditworthiness, usually using credit scores, income verification, and their overall financial history. Based on this assessment, each borrower is assigned a risk category. A low-risk borrower might get a lower interest rate, while a high-risk borrower will be offered a loan at a higher interest rate to compensate for that increased risk. Once the borrowers are listed, it's your turn. As an investor, you can browse through these different loan listings. You can see the loan purpose, the risk category, the interest rate, and other details. You can then pick and choose which individual loans you want to fund. Maybe you want to fund a small part of a loan for someone consolidating debt, or help someone start a small business. Alternatively, most platforms offer automated investing tools. You just set your criteria, like the risk levels you're comfortable with and how much you want to invest per loan, and the platform will automatically diversify your money across many different loans for you. Now, for the best part, earning money, the primary way you make money is by receiving regular repayments from the borrowers you've lent to. These payments typically come in every month and are made up of two parts: a portion of the principal you lent out and the interest, which is your profit. The platform collects these payments and deposits them straight into your account. This can create a steady stream of passive income, which is a major draw for many investors. Speaking of returns, let's talk numbers. What can you realistically expect to earn? One of the biggest attractions of P2P lending is the potential for higher yields compared to more traditional investments. While your savings account might be giving you less than 1%, P2P lending can offer annual returns ranging from 5% to 12% and sometimes even higher, depending on the risk you're willing to take on. The higher the risk of the loan, the higher the potential return. This makes it an appealing option for those looking to grow their money more quickly. As I mentioned, P2P lending can be a fantastic source of passive income. Once you've set your investment strategy Especially if you use an auto invest feature, the platform handles the day-to-day management. Your money's out there working for you, and the repayments just roll in. But that's not the only way to earn. Some platforms also have what's called a secondary market. This is a place where you can buy and sell existing loan parts from other investors. This can be useful if you need your money back before a loan term is over, providing some liquidity. It also creates opportunities to potentially buy loan parts at a discount or to sell your own for a small profit. Now, before you get too excited and start throwing all your savings into P2P lending, we need to have a serious talk about the risks. This is incredibly important. The single biggest risk in P2P lending is borrower default. This is when a borrower stops making payments and fails to repay their loan. If this happens, you could lose some or all of the principal you invested in that particular loan. Unlike a bank deposit, your P2P investments are generally not protected by government insurance schemes. So if a borrower defaults, there's no safety net to get your money back. Another thing to consider is liquidity risk. P2P loans are typically investments with terms ranging from 1 to 5 years. This means your money is tied up for that period. While some platforms offer those secondary markets I mentioned, there's no guarantee you'll be able to sell your loan parts quickly or at the price you want. If many people are trying to sell at the same time, you might have to sell at a loss to get your cash out. Then there's platform risk. What happens if the P2P platform itself runs into financial trouble or goes out of business? Reputable platforms have plans in place for this scenario, like appointing a third party to manage the existing loan book until all loans are repaid. However, it's still a risk to be aware of. Finally, the regulatory environment for P2P lending is still evolving in many countries. New laws or regulations could be introduced that might impact how these platforms operate and in turn affect your investments and returns. So it's crucial to stay informed about the rules in your region. Okay, so we've covered the good and the bad. How can you navigate these risks and set yourself up for success? The number one most important strategy is diversification. Do not put all your eggs in one basket. Instead of lending a large amount to just 1 or 2 borrowers, spread your investment across hundreds or even thousands of different loans. By investing just a small amount in each loan, the impact of a single borrower defaulting on your overall portfolio will be minimal. Most platforms make this easy with their auto invest tools. Next up, do your homework. Thoroughly research any platform before you invest a single dollar. Look into its history, its track record, read reviews, understand its fee structure, and most importantly, scrutinize its borrower vetting process. A platform with a rigorous credit assessment process is more likely to have lower default rates, which is better for you. When you're ready to start, begin small. Invest a modest amount of money that you're comfortable with. This allows you to get a feel for the platform, see how the process works, and understand the market dynamics without putting a large chunk of your capital at risk. You can always increase your investment later as you become more confident. A powerful strategy for long-term growth is to reinvest your earnings. When you receive those monthly repayments of principal and interest, instead of withdrawing them, put them back to work by funding new loans. This is the magic of compounding. Your interest starts earning its own interest, which can dramatically accelerate the growth of your portfolio over time. It's also important to not just set it and forget it entirely. Make sure you regularly monitor your portfolio. Check in on its performance. See what your actual return is after defaults and fees. And don't be afraid to adjust your strategy. Maybe you want to shift to lower risk loans, or perhaps you're comfortable taking on a bit more risk for a higher potential return. Staying engaged is key. Finally, don't forget about taxes. The interest you earn from P2P lending is typically considered taxable income. The good news is that in some jurisdictions, you may be able to deduct losses from defaulted loans against your interest income, which can help offset the tax bill. The rules can be complex and vary by location, so it's always a smart move to consult with a tax professional to understand your specific obligations. So there you have it, a complete beginner's guide to peer-to-peer lending. It can be a powerful tool for generating passive income with attractive returns, but it's not without its risks. The key to success is understanding those risks and using smart strategies like diversification, thorough research, and starting small to manage them effectively. I hope you found this breakdown helpful. If you have any experience with P2P lending or any questions, please drop them in the comments below. I'd love to hear from you. And if you enjoyed this video and want to learn more about smart ways to manage and grow your money, Make sure to hit that like button and subscribe to the channel. Thanks for watching, and I'll see you in the next one.